Welcome to Investing for the Unpredictable. I'm Shauntel Leeson, your host. And a lot of you asked a lot about hedge funds. So I have a special guest on today, Siddharth Singhai, and he is a hedge fund manager. And I'll let Sid take it from here.
Well, it's my pleasure to be here, and thank you for inviting me to the show.
You're welcome. I have a quick question to ask you before you get started today. People ask a lot of questions about the different types of funds, the mutual fund, exchange-traded fund, hedge funds, and index funds. Would you mind taking a little time with us and explain the differences?
Mm-hmm. So I think in one category, when there are no human beings involved, typically, you get the index funds and the ETFs, and where you have somebody looking over actively, a human being who's doing the active picking of assets for you. In that category, you have mutual funds and hedge funds. Now, within the categories, so hedge funds and mutual funds, I'll begin with that. They're very similar. You just have some professional hedge fund manager or team of analysts working with him who are putting together a portfolio for you. And this could be anything. This could be real estate, gold, bonds, could be cryptocurrencies, it could be stocks or other asset classes. And they have more freedom as to where they decide to put your capital. And they're less regulated and typically have higher fees than a mutual fund would. But the function is mostly the same. Mutual fund, very similar to a hedge fund. You'll have some professional hedge fund manager and his team putting together a portfolio of assets for you that hopefully will do well over time for you. But they are more restricted, more strictly regulated in what they can invest. And the other difference is obviously you can start with very little money in a mutual fund, right? A few $1,000s compared to a hedge fund where you have to be an accredited investor. Now, the definition of that has been modified. Previously, you had to have a net worth of over $1 million, but there have been amendments over time to it. But typically, a hedge fund minimum would be something like $100,000 or $250,000. And it's typically assumed that a hedge fund will have more risks, and you really are going for out and out returns. So that's not the case with every hedge fund, but I think those are the differences between hedge and mutual funds.
Wonderful.
And ETF index funds are almost the same. ETFs just allow you to trade more easily. You can buy and sell more easily. And they're really an automated way to invest. So when I say I'm buying the S&P 500 index or ETF, what I'm really doing is, and in this case, S&P 500, we have 500 of the biggest businesses in the US, all ranked by size. And then when you buy that index, you just put your money in each of those 500 stocks. Now, you don't put equal amounts of money in each. The bigger stocks get more of a weight in your portfolio. They have a bigger weight in the S&P 500. But that's essentially what it really is. You take 500 of the biggest businesses, in case of S&P 500 index, and you just buy a little bit of all of those. And there's no person who's doing that for you. It's almost automatic. The fees are typically very low. Barrier to entry is pretty small, and you can get started with very small amount of money. And so almost the same thing with ETFs. It's just they're more easily tradable for those that want that.
Wonderful. Now tell us about your fund.
Yeah. Name of our fund is IronHold Capital. I'm the chief investment officer and co-founder. And we invest both in US and India, predominantly equities, because that's where we believe the big long-term gains will be achieved. And India is really, I would say, a differentiating edge. We looked at the hedge fund landscape and also mutual fund landscape here in the US, and we found that there are over 10,000 hedge and mutual funds put together, and they're looking at, 3,700 stocks, public listed stocks in the US. So what typically happens is it's very hard to find those asymmetric opportunities where you have very little risk, very high reward. And because there's so many people looking at the same opportunities, it's very difficult. It wasn't the case 50 years ago. There were very few players in the field, and even information wasn't easily accessible. So what we found was in India, it's the exact opposite. In India, you have less than 500 hedged mutual funds looking at over 5,000 public listed equities in India. And I think that from time to time, for us, gives us great opportunities to buy things for way less than what they're worth. And that phenomenon is called efficiency. Now, our strategy really is value investing, which is we find high quality businesses that are temporarily out of favor, or there's some negative sentiment around them that really hasn't caused the underlying business to lose value, but the perception about that business is negative for no good reason, temporarily. And that's where we go in, because over long periods of time, performance of a business and performance of a stock should be parallel or should reflect each other. And that's what efficiency is. In the short run, anything could happen. A business could do exceptionally well, but the stock could tank. And that's where the opportunities come in for people like us. We're just looking for things selling way below our valuation of their intrinsic value. And then we just buy and hold, and then we wait for the efficiency to catch up.
Okay. Let me ask you, now, because we have people from all around the world looking at our online show. Would someone in the US as well as in Europe be able to have access to invest in this fund?
Yes, I think so.
And what would be the appeal to anyone, whether they're on this side of the globe or the other side of the globe? What would be the most important appeal to them?
I think as I mentioned, India, right? India has tremendous opportunities ahead of it. It's growing at twice as fast as the US and has done so for almost 25 years.
Yeah.
And there's less competition. Essentially, you want to be in a lake where the fish are fatter and the fishermen are few. And you get both of those in India. You get more growth and you get less competition because fewer hedge funds, fewer mutual funds. And I think that will be a great place to be 10, 15 years from now, if you've invested for that long period of time, just because of the structural tailwinds. It's not it's a developing economy.
Yeah.
So it needs infrastructure, it needs medicine, it needs, more of a robust financial system. And so practically every industry in India is going to grow because the demand is there. It's not getting satisfied. And that creates opportunities for businesses to become big, right? Much like the US of the early 1900s or 40s, 30s.
Yeah.
Things were growing. So what you don't get in a mature economy like US is growth.
Right.
And I think that's where India presents itself as a great opportunity. Now, it's even more important because, as we just saw with the inflation numbers just getting hiked up, as we saw over the last week or so, US dollar is in a kind of a tough spot because of the huge budget deficits and all the stimulus that we've had over the last year or so. And so if you want to protect your investments from devaluation, the US dollar, you can do so by investing in other countries, other currencies. So it also provides you with a natural hedge. If you want, US is a great country to be investing in, but I think it's wise to have some of your money in some other currency that's probably less correlated with the US dollar. And so you get the growth you get less competition, which means more opportunities for us to generate bigger alpha. And you also get the natural currency hedge. So I think and this is for all investors worldwide, but especially for people in the US, where the US dollar is and where it could go, I think is sort of a scary place. And so diversifying some of that would be a good idea.
Now, India is part of what they call the Bric nations, right? Compared to the other countries that are growth, would you say India is probably going to have the fastest growth? Or how would you define that compared to the other Bric nations, the Bric countries? And define the Bric. I don't want to use terms that the public can't understand.
Well, I should say, it's not a good term for India particularly, because India is sort of unique. I think what you're really looking at is the few countries that I think would make sense as a competition to India, be it China,
right,
Singapore,
right,
India, and to an extent, South Korea.
Okay.
I think so. It's not really the right term. I would say the right term would be emerging markets.
Okay.
That have stable governance and that also have a capitalistic society. Because just because a nation is emerging, what we really mean is it's going to be developed
right
over the next 50 or 100 years.
Yeah.
You should be looking at something that has the foundation that will allow it to become a developed nation over time. And the foundation is capitalism and good governance, or at least okay governance.
Okay.
And I think when you look at what are all the democracies in the world, because that's the most stable form of governance there could be, and what's a capitalistic economy that rewards individuals for doing the best they can, and hence the whole nation gets richer as a whole, as it happened with practically every capitalistic country, US and even China recently after the 60s.
Right.
So I think a better definition would be, what's a great emerging market with great fundamental national structure, be it politics or be it economics. And I think in that sense, there are very few countries that have that. China is a great place to be, in addition to India.
Right.
It's growing rapidly. But governance is sort of a hybrid between communism and capitalism.
Okay.
And what we've seen across history is that freedom is very important to people, and dictators tend to be overthrown. There's political instability in those places. And will that happen with China or not? I can't really say, but I'd be less comfortable going to China. I would much rather be in India, where, of course, it's not quite as developed as China yet. Markets are sort of slightly harder to get to, just from a financial perspective. The regulations are trickier, but the fundamentals are there.
Okay.
You have a nation which is much like the US of the 1800s, 1700s. It's built on foundation of democracy and also capitalism. And so that over time, if maintained, should do well. And so I think the allure for other investors, is not just the growth, but it's also sustainable growth. Because if you have you could grow for a long time as a communistic economy, where government controls all means of production. But that's not sustainable. The government is not very efficient at running businesses.
Right.
Less governance there is, the better it is. And the more entrepreneur friendly a country is, the better it is, much like the US. And, to illustrate my point, I think if you look at the 1700s, China had, I think, almost 20 times the population of the United States in the 1700s. But if you compare the GDP of US over time, because of capitalism, multiplied at a rate that China could not even hope to keep up. China was the biggest economy, ancient China. But because it did not embrace capitalism, it just suffered badly. And same was the case with India. India was sort of more under the colonial rule. So it did not have a chance either. US got lucky. US had great governance from the very beginning, from the day the Constitution was laid. And, a capitalistic economy is a must if you want to create long-term wealth for the entire country.
It also gives more freedom for entrepreneurs to develop, to make mistakes, and to keep growing. Whereas in non-capitalistic countries, there's too much regulation to prevent businesses from developing and growing.
Absolutely. It's because how we lift people out of poverty in any country, it's going to happen over time, and it's going to happen through businesses, because ultimately productivity is very important. And any law that either inhibits that too much, though regulations are important, but you have to keep them toned down, right? So that you allow the economy to develop. And so, if you take all those things into account, the very few countries that then become, an attractive prospect for capital allocation. India has all of those things going for it at once. Perhaps I think the only drawback is the difficulty in accessing those opportunities because of the regulations that exist right now, because it's strict, the financial market. So I think that's where we come in, and that's how we navigate, through our infrastructure and, access to the Indian markets, those difficulties. I was born and raised there, so I understand the market and the regulations. And
it's a younger population too than the U.S. I think the U.S. is a maturing country. We have an older population. Whereas a younger population, there's more of a desire and an opportunity for people wanting to see new developments. I think of like the U.S. was back from the 1920s till about the largest peacetime economy after World War II. It was exploded with all kinds of new ideas and new products and services. And I like to compare India, if you will, to that, in that you're a young population and you're coming out of a very difficult financial situation and growing exponentially. Yeah. So a lot of opportunity for investment opportunities that many people don't even see or not aware of.
Yep, absolutely. It is much like the US of the 20s or even before that.
Yes.
Industrial revolution, post that, So, structurally, India is just so advantaged because of all of those things now. And because of technology, you also get access to financial information, which I think was the biggest hurdle back in the 90s, where, yes, India as an economy was doing better, but you just didn't know. You had to call the broker. You had to, he would give you a code maybe in 3-4 hours, maybe a couple of days. And so buying and selling of stocks was difficult. So that also scared away a lot of foreign investors back then. But the great thing is it has the combination of great technology that gives you stock prices by the second, but also less competition because it's not quite there yet. Now, it will be over time. As the financial markets develop, there will be a lot more hedge funds and mutual funds and venture capital funds coming in. But I think that will take time. And that's why we believe over the next decade, there's going to be a lot of great opportunities in India.
Right. And the fact that there was a growing population and with people looking to invest there, that even builds that bottom base for any kind of investments. And then that's when Americans step in. Of course, we go in with a lot of money to go and invest more to keep up with what's going on in our own purses. I appreciate the time you've taken with us. Give us a little bit more before we wrap up here for the afternoon. What are the things you think our investors would like to know?
Well, I think if you're an everyday investor just starting out, I would say one thing that people underestimate is compound interest, which is people have the perception that in order to make money, I'll need to have a lot of money to get started with, and that is sort of false, because if you were invested in the S&P 500 index fund over the last 25 years, and if you had just invested, I think it was $2,000 every month over that period, you would have north of $1.4 million.
Okay.
Right. And you had to do nothing. You had to just every month put aside $2,000 and just keep it in the index fund. And it would have, you didn't do any work for that money. You didn't have to analyze stocks or anything like that. And you didn't have to start with something huge. So the key is getting started early, even if you're starting out small, and just consistently being in the market instead of timing the market or trying to beat the market. I think that's key for investors, because over time, just those small amounts of capital that will grow into a huge pile just naturally through compounding.
So it's consistency and discipline.
Absolutely.
Consistently saving money, have the discipline to save on a consistent basis. And what has happened, I think about in my parents' generation to this generation, is that today we have people that can manage money for you. You don't have to pick out the stocks on your own. You just pick out the hedge fund manager or whatever it is you're looking for and go and let them make the decisions and watch your purse grow.
Yeah, I mean, picking out a good hedge fund manager is also way difficult. It's tricky. And it needs a lot of research. I mean, you have to look at the strategy. If the manager has guts to stick with the strategy, because eventually the odds are going to be against you. And some years you won't make money. That's just inevitable.
Well, that's with any investment, though,
And so even if you're investing with a manager, what people do is equivalent to running from one bus stop to the other in order to catch a bus. Instead of staying at a stop and eventually you will get a bus. It's possible if you keep, running around trying to catch a bus, you might never catch one. And that's what they do. You see 1 year of great performance, people pile in. You see the next year he doesn't do well, you pile out, go to someone else.
Yeah.
And so funds themselves could do really well. And I think there's a study on it. I don't exactly remember the facts, but I think the average mutual fund investor, and this was a top quartile of mutual funds, the actual mutual fund did 11%, and the investors in that mutual fund did 2%. So that's what that bus effect is. People will not stick with an investor for long term, which I think
right.
Difference.
Lack of discipline.
Yeah.
They're not being taught by whoever's advising them that you just can't hop in and out. The hopping in and out, you lose money. When the market goes down, you jump out. You lose money by not weathering the storm. It's like watching your kids grow. You can't throw them out if they act bad. You have to let them go through the whole cycle, right?
Absolutely. Yeah. Yeah.
Well, listen, I'd like to ask you this. I really enjoyed listening to you, and I'm sure my audience has. How can they reach out to you if they want to reach out to you or find out about Iron Capital?
Yep, IronHold Capital.
IronHold Capital. How do they reach out to you? Can you put your information in the chat box and so people can follow up with you?
Yeah, I'll put it there as well. They can reach out to us on our website, ironholdcapital.com.
Okay.
And we're also available on LinkedIn. So they just Google me. They should be able to find me on LinkedIn.
And if they're in Europe anywhere, like I have people that are on our show that are from Portugal and England and France. In fact, my daughter's going to be going to school in France. And Greece and place, so can they invest in that fund, or are there certain locations that can or cannot invest in the fund? What's the parameters on that?
I think they should be good to go.
Okay.
Obviously, we'll have to check with our legal counsel on that, but I think most investors should be good to go. There are some countries that might have to do a more KYC heavy approach. But yeah, I think most of them should be good. Okay.
And my other question is, can I get you to come back in the future?
Pardon me? I missed that one.
Can we get you to come back for future meetings on our show?
Absolutely. It would be my pleasure to do so.
Wonderful. Anything else I should mention before we wrap up for the afternoon here?
Well, I think we covered everything, and I would just say thank you for inviting me.
Okay. Well, thank you very much for being with us.